Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions, generally related to three different topics: wealth building, commodities, and/or financial topics. So we're going to dive right into what people are sharing, and I'll share my opinions. If you want to follow me, it's at Finding_Finance. If you want to join our community, finding-value.com, where I dive deeper into all of these topics, looking for potential investment opportunities. Mayday coupon code is still active. So Steve, Millionaire Habits, he says your 20s and 30s are the time to bust your butt and build ridiculous wealth, not a time to find a low-stress, comfortable job. What I'll say there is your first job or two, try to gain experience in something that you want to do for the rest of your life. And what's really difficult, at least was difficult for me, is I didn't know what I wanted to do. Even in high school, I didn't know. And even in my 20s and 30s, I didn't know. So try to find something that you are passionate about where work doesn't feel like work. And the harder you work at that thing, whatever it is, generally does a lot better for you. Don't go into something that you don't like. It doesn't mean that you can't have a temporary job, but I mean, don't try to go into something just for the money. And I think a lot of people, I mean, it's got to pay enough to be able to live, but don't get into something where it's just money and it's something that you really hate to do, because I just don't think you'll be there and learn anything if you hate doing it. So I've had my kind of wake up calls. I was pretty, I guess, naive in my 20s. Got out, thought the whole system was based off of hard work and was completely based off of merit. I think it is partially depending on who your bosses are, but there's a lot of favoritism, and then it's gotten worse and worse with time, based off of things that are outside of the control of the person doing the job. So lots of favoritism and buddy systems. It's very political, and sometimes there's things that you just that you can't do, that you can't help because you're born a certain way or you're a certain gender or whatever. So there's a lot of uh, it's not inclusion, but the opposite, exclusion, I would say. But what I would do is find something you like, try really hard at doing that, find a mentor if you can, learn that sector as best you can as quickly as possible, and go where you are appreciated. And also go where they pay you a livable wage or far more than a livable wage. And then save as much money to diversify your income streams. Save a bunch of money. Try to save as much as you can, 20, 30, 40, 50, 60, 70% of your income if you can. And then build other revenue streams, income streams. Because when you build income streams, you are more resilient. You don't get all of your money from one income stream then. If you're getting it from four, five, six, seven, however many you build, your resiliency goes up. And if you lose one of those income streams, they become less important. Each income stream becomes less important the more and bigger that you create those income streams. A little bit less, more of a low stress situation. Ben Carlson says, why do people love housing so much as an investment? It's an illiquid asset without much volatility, out of sight, out of mind, and prices rarely go down. Nationwide, housing prices have fallen just 7 times in the past 75 years. Well, what's good about it is you can leverage the heck up using a mortgage from other people's money at a bank and then make money off of the entire amount. So even if you're, a 3.6 or 6% increase is a gigantic increase when you have very little equity in the house. It's all leveraged up. And then you can also cash flow it on the rental side. So you have price appreciation on the asset, and on top of it, you can cash flow it if you buy it at a good time. And if it rarely goes down, you rarely see a negative, a downward move in prices, which makes it very easy to psychologically hold on to it. And even though the 7 times that it moved down, 0.7% and minus 0.2% is really nothing. I mean, that's really not a down move. And that was at a top of a bear market. So we had a lot of inventory during that housing we'll call it crash. This is the crash, really. This is a larger downward pull here for this between 2007 and 2011. But that's kind of more of a unique situation, I would say. Quote from Peter Lynch, he says, moderately fast growers, 20 to 25% in non-growth industries are ideal investments, according to him. And I'm trying to figure out why he would say that in a non-growth. So that would be like utility companies or something that provides something in non-growth industries. But obviously those companies are doing something right, is what I'll say. Logan says, we have the lowest percent of underwater homes in history. Only 1.8% of mortgages have negative equity. Approximately 1 million homes, most borrowers have better than 50% loan to value ratios. And this is percent of loans here. So hardly anyone has negative equity. The death here where you get underwater, you get negative equity, where you owe more on the house than what you have for a loan. So you owe more on the house than what the house is worth is negative equity. And that basically hurts you because you can't sell the house without paying to get out of it. That's what negative equity is. So what a lot of people do is when they get into negative equity, where the loan on the house is higher than the value of the home, they walk away from the home and basically foreclose on it. But we've seen that foreclosures are really, really low. So this is not like 2008. It's not like 1920s where they had a huge bust cycle. We have a ton of homes that have negative equity, and people are just walking away saying, "Screw it, I'm done," and going to short sales and/or foreclosures, and then eventually bank-owned homes, where we had that 2008 collapse, which is basically this. It's this big collapse here, and that was all from negative equity and foreclosures and bank-owned homes and short sales. That's where this came from. That is a very rare instance in history. So people talking about the 2008 crash and equities, I don't think they have an idea of where that came from. This is where it came from. It came from negative equity in the houses, and it came from the big crash. Now, there wasn't negative equity in 1990 housing market crash. There wasn't negative equity in 1974 when we got that slowdown. We had a slowdown in 70. We had a slowdown here. And then we had another slowdown after, which is over here, 82 and stuff like that. We still went up, but those were slowdowns in the housing market. We didn't have this deleveraging event. This is a deleveraging event. China right now is going through this deleveraging event where prices are going lower and they are deflating. The people that talk about these huge crashes, you got to have negative equity. You got to have foreclosures to get that move, the forced selling pressure to do this. It's got to force the selling, where you get all these homes where it's like, crap, I don't know what to do with them. And then they just start liquidating the homes at way lower prices just to basically reclaim some of that outstanding loan for the banks. We're not in the same situation as all this is saying. Coming down to Tavi, he says, if precious metals companies were a sector, they would have the highest cash flow margins in the S&P 500 index today. What I want to say is just look at the top couple here, out of here. So this is cash flow margins by sector and gold companies. So median figures for the S&P 500 index sectors plus precious metals companies greater than 1 billion market cap in the Canadian and U.S. exchange. So they have 40% in precious metals industry. There's 35% in energy, and then financials are 32%. And I don't really go and look at these down here because they just don't make enough money. But over here is where I get really, really excited. And what is even more crazy is if precious metals continue to go higher, those margins are going to get bigger, which is good. It's an investment opportunity. And then you look at what is the price of those equities? Well, they're low, which is crazy. They're low, and same with energy. It's low. It's cheap compared to other equities. But they're the ones that have the biggest margins. I know, confusing. I get it. And I also think that the commodity of energy and precious metals will continue to go higher, increasing those margins, or at least keeping them large if their input costs go up. Here's the housing economy from Warren Pies. He says mortgage rates peaked at 7.25% in May and have now fallen in a straight line to 6.3%. Yet mortgage purchase applications have not responded. We expect lower rates to revitalize the market. However, it has not happened yet. So that's something that we want to continue to watch. It says if mortgage applications don't respond to lower rates, then it could signal trouble. And I agree with that because that's what I'm watching as well. If rates fall to 6% and applications don't tick up, it's a problem, is what he's saying. So if mortgage rates continue to go down, you can see this is a dot plot. And this is basically your MBA US Purchase Index. So these are applications or the purchase index versus your mortgage rate. If mortgage rates go down and they don't start to go up, we're going into levels or areas that we haven't seen before. But I'm sure it's going to take a little bit of time because they just fell quite recently. So we'll see it fall and we'll see where this ends up. I am guessing that this is going to go upward. Mortgage applications are going to go up as rates fall. But again, we have to actually see the data. I like that chart though. Is copper set for another bull market? Bank of America now forecasts that copper supply will be 15% lower or 5 million tons than demand by 2030. The bank also expects annual copper demand growth to double to 4% per year, driven by renewables, grid infrastructure spending, and electric vehicles. Over the last 4 years, copper prices have rallied 46%. At their peak in May, copper's 4-year gain was as high as 110%. If these estimates turn out to be correct, we will see much higher copper prices in the next few years. Copper is a hot commodity. Here is the demand in the light blue going up, and there's the base case of supply looking at 2025, 2026 onward, and the deficit that is created out in the future. It's going to be a tailwind behind copper prices going up with those shortages that are projected. And obviously, we need those shortages to be realized, not just projected. And then your inventory will draw down when the deficits hit, and prices will go up, probably to a level that will kill demand if the demand and supply have these type of deficit. And that could be at a very high price. We don't know where that price is. We'll have to wait and see. Howard Marks says psychology swings much more than fundamentals, and usually in the wrong direction or at the wrong time. Understand the importance of resisting those swings. Profit, if you can, by being counter-cyclical and contrarian. That's where the value and price disconnect. It comes from the psychology swings and the sentiment in the markets. We should be profiting from it, not being victim of it. Finance guy says people that think renting is wasting money have no idea how expensive owning a home is. Wait until they find out how much money is wasted in interest, PMI, closing costs, and repairs. I think that is valid if you're looking at a house when in the short term. If you look at a house in the really long term, then owning is far better than renting because renting continues to go up. And if you buy a house at a specific time, there's some times in history that homes are just an absolute steal to buy. The best time in history to buy a home was 2009, 2010, 2011, 2012. That was the best time to buy a house probably in anyone's lifetime that is alive. It was low interest rates, cheap housing costs, they all kind of deflated, and it was the best time in history to buy. And most people don't even realize that. And then what they do is they look at home prices a few years ago or today, and they compare it to the cheapest time in history to buy a house. And then they say, well, it was so much cheaper back then. This is all overvalued. I don't think it's overvalued necessarily. You're just comparing it to the cheapest time in history, which I think is an unfair comparison. Is it on the expensive side today? Probably. But that also means that we have a shortage of homes if you're on the expensive side. Homes don't get cheap when there's a shortage. They get expensive. And renting, it depends what kind of lifestyle you want. If you're comparing a 1 bedroom or 2 bedroom apartment to a house, I think that's an unfair comparison. If you're talking about renting a house and buying a house, where I live, they're pretty comparable right now. And it depends on how much money you put down. You have to put money down to get the best price on the house, to get rid of private mortgage insurance. So yeah, you have to save up that money. Now, here's another question that I have. What's the first thing that most people are going to do if they won a bunch of money? So if I won $10 million or if you won $10 million or somebody wins 10 million, I am willing to bet that a lot of people, the majority of people, are going to say, you know what, I'm going to go look for another house to buy. Or if they're renting, they're going to say, I'm going to go look for a house to buy. Why does everyone, if they win a whole bunch of money, why do the majority of people want to go look to buy a house? And the reason I would say is, and I have come around to the idea that you want to buy an expensive house in an area that people can't buy around very much. And the reason is it blocks people away from you to some degree. You don't have to live on top of each other. If you go buy a $2 million house, at least here, a $2 million house is going to afford you a very private property. And there is a cost to being private. And it's not about owning a house where it's gigantic. It's about owning something that is nice, but while also being private and basically blocking people away from you that might be, I'll say, less than ideal citizens, is what I'll call them. People that you just don't want to deal with. And it doesn't mean it's because of socioeconomic status. It's just you might not be living around certain individuals that are causing problems. So it's a way, it is a privilege to some degree, and it's a way to ensure that you're in an area that might be safe for your kids if you have kids or if you've got a family. And that's the way that I view it now. It's just a way, the more expensive the house and the more expensive of the neighborhood or wherever, you're kind of just blocking people out to some degree, and you're only letting certain people in that cross a socioeconomic income level, whether that's right, wrong, or indifferent. Investment Wisdom says value investing is a large-scale arbitrage between security prices and the underlying business value. Exactly. And that's exactly what you should be honing in. Now, here's the tough part. What's the value of a company that has absolutely no income? Like most uranium companies. What's the value of that? And a lot of people are going to say, well, the value's in the what's in the ground. It's their uranium pounds in the ground. And what I'll say is yes, but that's not how you generally value a company. It's future cash flows that determine the value of the company. And that's where the risk comes in. Companies that do not have cash flow are higher risk. Money Wisdom says, do not save what is left after spending, but spend what is left after saving, which is Warren Buffett. This is exactly what I do. I save a bunch of money. I try to hit my targets of what I want to save, and then I spend what is left. And it doesn't mean that you go full crazy in terms of being completely cheap. You can buy high quality stuff, but still be frugal at the same time. You just don't buy unneeded crap. But if you buy needed stuff, you still buy quality stuff at a good price. That's basically my entire life. I'm trying to find where the curve between value and price starts to flatten. And that's where I buy the majority of my stuff. So, for instance, I drive Hondas. I drive cars that I think are easily fixable, easy parts, and then are pretty reliable. So the combination of all those things, and I also look at, are they easy to fix? Buying a transverse mounted V6 where you can't change the spark plugs on one side, which is pretty difficult for some cars, I probably would avoid those. A 4-cylinder transverse mounted 4-cylinder with the spark plugs on top, super easy to change. I'm in. Let's do it. I don't care about the power on my day-to-day driving. I just care, is it reliable? Does it get decent mileage? Is it fun to drive to some extent? And is it easy to maintain? And some cars, I will be honest, are a complete pain in the butt to maintain. Here's a Renko chart for silver. So bullish on silver. We can see the breakout and the potential retest here, and that looks like an absolutely bullish chart. It looks really good for a move higher. A global market investor, he says, this is one of the most drastic bubble bursts in modern history. China's real estate stocks are trading at nearly the lowest level in 20 years. Property shares have declined by over 90% in just 4 years. Artificially pumped economic miracle has finished very quickly. And it deals with their demographic, guys. This person doesn't even know what drives it. It's the demographic. The demographic coming into home buying years fell off a cliff. That is deleveraging. That is a problem. That is what a problem looks like. If you guys want to go study what the problem looks like real time, go look at China's property market. Go look at the real estate market and figure out how it went bad. And look at the demographics. Here's Grady. So this is a very big picture ratio chart. Now shows silver breaking out plus backtesting versus the S&P 500. It means a historical global asset class rotation is in the making, away from overvalued paper assets toward undervalued hard assets. True lifetime opportunity here. So this is the breakout and the backtest that we're going under right now, and a potential move higher. A lot of people are probably becoming impatient with silver. It's like, guys, if you don't see these types of patterns, this is what allows me to be patient. Just sit and wait. Investing is like 99% waiting, 1% action. So you go and you buy it, and then everybody thinks it's going to go up immediately. That's not how investing works. You find good opportunities, you buy it, and then you sit and wait. And a lot of the times, sometimes it doesn't go the exact moment. You wait a little bit, and then you ride it on higher. You ride it up way, way, way up there. And when it goes all the way back up here, silver's going to be, silver mining stocks could be up 5, 6, 7, 800%. Could be up 30x, 3,000% in a short period of time. It depends what you're in and how big the move is. People don't know how big the move is, to be precise. What we have is we are identifying good chart patterns and good valuations. And then you take action when the alignment does come. He says, when price for this ratio chart moves up, silver outperforms the U.S. stock market. We're just looking at it from a ratio perspective. And there's a whole bunch of other things that are in alignment right now, not just silver versus SPX. There's like 50 other charts. Lynn Alden says, my September newsletter's out. It discusses ongoing fiscal dominance and its investing implications. The total deficit is really the net interest outlays plus your primary deficit. And that's what your total deficit is. And it's getting larger and larger, and that's the fiscal dominance going up. That's all it is. Percentage of GDP, almost 10% up there, and it's like 7% or so right now. The oil market is too bearish. Non-OPEC supply growth will disappoint in 2025. So by being so universally bearish in both sentiment and positioning, the oil market is going to force an extreme out of the supply and demand models. You can't have low prices and higher supplies, just like you can't have high prices and high demand. So that's what his opinion is there with the oil markets. Another one from Grady. This is the gold miners are bottoming, big picture versus gold. It means that gold miners are about to outperform gold in the long term, and that means the real bull in miners is about to start. And I'm positioning in this. Everyone on the website that's on there, they can do what they want, but they're seeing me position in this, and there's reasons behind it. And finding those good companies is critical at bottoms, because that's where your returns are going to come from. You need to scrutinize the companies themselves to find the good companies to jump on the train with. This here is your slowdown. It's the train coming down and stopping. This is your dead period. Your dead period is where the train, where you want to get onto the train. And then when the train leaves, it's going to go on up. It's going to leave a lot of people in the dust because they're going to be chasing or FOMOing over companies like NVIDIA when they should be looking at this. It says ratio charts are about relative strength. They compare the performance of one stock relative to another, and they are a useful additional tool for figuring out direction. In a PM bull, miners lead the big picture. Here's Eric Nuttall. Says record low global oil inventories, record high seasonal global demand in August, record low financial demand for oil, and sentiment seemingly at a multi-year low. The market is drowning in bearishness, but has the sentiment pendulum swung too far too quickly in his question mark. Here it is in terms of global reserve inventories way down there at that real low point here. And then here, this is your positioning that's down in no man's land. This is the biggest story in the world right now is China. Everything else is secondary. The last time China was deflating this hard, it was 3% of global GDP. Now it is 20% of global GDP. Undeniably having effects worldwide and cannot be ignored or discounted. So this is China's economy-wide prices in longest decline since 1999, and here it is. This is the real estate bubble popping. That's a deleveraging event. So prices fall during a deleveraging event. And I don't know if stimulus can turn this around quickly. I don't think it can. And that's what I've got for today, guys. So give me a thumb up for the content, subscribe to the channel, subscribe to the website. Mayday coupon code is still active. And that's all I've got for today, guys. So we'll catch you next time. This is Finding Value.